Namaste, welcome to Arthaniti. Today I'll help you understand in simple terms some financial news amidst this Russia-Ukraine crisis. Now, one major news that came today was that the Russian central bank increased its benchmark interest rates to 20% from 9.5%. This more than double increase and its implication, why the Russian central bank had to do so, and how the central bank benchmark rates are related to inflation in the economy and how they stabilize the market. That's what I will help you understand in today's video. So keep watching. Okay, now before we go on to decode whatever I told you, I'll tell you some backgrounds because of which this decision was taken by the central bank in Russia to more than double the interest rates. After Russia invaded Ukraine, many countries from around the world imposed sanctions on Russia, right? The Russian central bank was deplatformed from the SWIFT messaging system. Now, what is SWIFT? SWIFT is an interbank messaging system which connects 11,000 financial institutions in more than 200 countries. Now, after having deplatformed, after getting deplatformed, what has happened is the central bank has no access to nearly $640 billion worth of foreign exchange reserve that Russia holds outside the country. Where is this going to impact? It is obviously going to impact on the valuation of the Russian currency. And it did rightly so happen. Not more than 15 days back, the Russian ruble was pegged to a dollar to somewhere around 77 rubles to a dollar. Yesterday, after the SWIFT system deplatformed the Russian central bank, the Russian ruble collapsed. It nosedived to 120 rubles a dollar. So what is going to happen? See, every import that Russia does, every import that is coming into Russia, the Russians will have to pay more because the value of their currency has decreased. Now, in Indian context, say suppose we are importing a product from outside the country in India, and for every liter of say petrol that we are importing, we are paying $1 per petrol. Now, this is just a simplified example. Please don't troll me because I'm quoting such figures. This is very trying to explain you in very simple terms. Right. So, say suppose we are paying $1 for every liter of petrol that is imported in the country. All of you know that Indian rupee to a dollar, the exchange rate is pegged at somewhere around 74 to 75 rupees a dollar. Now, if the value of the Indian currency goes down, say suppose from the current 74 to 75 rupees a dollar, the value of our currency goes down to 100 rupees a dollar. For that every liter petrol that we are going to import, where we were paying 75 rupees, the exchange rate for $1, we will now have to pay 100 rupees for that same dollar for that same 1 liter of petrol. Are you understanding the implications of devaluation of currency? Now, if we are paying more to get the same quantity of import goods, what is going to happen in our country? The prices of that particular imported products are going to rise. So, any rise in prices is what? Inflation. Right? Now, coming back to this rate increase by the Russian central bank. Now, the central bank of any country resorts to monetary policy by way of which it manages the money flow into the market. Now, inflation is not bad, right? You need inflation. Why? Because people have money in their pockets, they demand goods and they pay to get those goods. So inflation is good, but inflation up to a point is good. The upper tolerance limit for inflation in India is set at 4.5%. In Russia, it is set at 4%. Now, looking at the decline of the Russian ruble, inflation or inflationary trends are going to set into the country. So the Russian central bank came to the rescue to keep a check on this inflation. So by increasing its benchmark interest rate from 9.5% to 20%, what it has effectively done is it has increased the cost of borrowing. In the sense, people will get more interest by saving the money rather than by taking loans and spending the money. Loans are going to get dearer. Interest rates on loan will increase. Now, this benchmark interest rate basically helps to curtail inflation. By increasing the rate, inflation is kept in check. By decreasing the rate, more money goes into the hands of the people, demands increase, and people start spending more. So the relationship between a benchmark interest rate of a country and the inflation is inverse. When the rates goes up, it is normally to curtail the inflationary trends. When the rates go down, it is normally to increase the churning in the economy, which leads to inflation. But again, which has to be kept in the between the upper limit set by the central bank of the country. Right? Now, there are talks that the American Fed, the central bank in America, is going to increase its interest rates following the packages it had put in place for the economy not to go into a downward spiral following the COVID outbreak. Now, come March, the Russian Fed was going to increase the interest rates. Why? Because Americans are facing unprecedented inflation they have not experienced in the last 40 odd years. Now, to keep that inflation in check, it is very, very necessary that the American Fed will increase their benchmark rates. Now, when that happens, what is going to happen? Money from the economy is going to get sucked up. People are going to stop taking loans. People are going to be, I'm sorry, not stop, but people are going to refrain. I'll rephrase the sentence. People will refrain from taking loans and spending it. Why? Because the loans are going to get dearer. The people will have to pay more to take loans than what they were paying now. The same is the case with India. There are talks that the Monetary Policy Committee of the Reserve Bank of India, which meets at least 4 times in a year, has kept the interest rates unchanged for the last since March 2020 outbreak of COVID. And looking at the inflation in the country and the benchmark of 4.5 levels of inflation, the central bank in India, the Reserve Bank of India, will also be gradually easing out the interest rates and increasing them. What is going to happen then? Again, loans are going to get dearer. People will get less attracted to taking loans and more attracted to saving money. Interest rates on fixed interest earning securities would go up if such a move is taken by the central bank. So I hope you understood in simple terms. I tried to explain it in as simple terms as possible and how the central bank actions has a direct impact on the economy and the inflationary trends in the economy. Right? So, I hope you enjoyed this video. I hope I was able to add some value to your financial literacy. And do ask questions if you have any. Like, share and subscribe my channel. And see you tomorrow. Good night.